Good day, this is Attila Kovács from GTC News with the stock scope results for the 6th week in 2018. Having an earnings report is always a blessing for every company, be it as it misses estimates or not. The companies always learn many details of their own operation strategies, future performances, while investors get a pretty good idea if they want to go with the firm or not. Last week's results have given us those we have expected, in some cases even better despite of the recent market situations. Please read the following some carefully because it is giving you small facts which are important for any traders. First up is the BristolMyers, which has released its quarterly earnings guidance on February the 5th in 2018. The BristolMyers reported $0.68 earnings per share and earned $5.45 billion during the quarter. The company had a return on equity of 33.68% and a net margin of 4.85%. Its revenue was up 3.9% on a year-over-year basis. BristolMyers posted loss for the fourth quarter in 2017 compared to profit in the prior year, reflecting impact from US tax reform. Both adjusted earnings per share and quarterly revenue topped expectations. It also announced positive results for its Opdivo and Yervoy cancer drug combination in a late-stage clinical trial. The company expected adjusted profit for 2018 to be established as its business shows strength on the aforementioned products. Walt Disney is the next up. It's released its quarterly earning guidance on February the 6th in 2018. Walt Disney reported $1.89 earnings per share for the quarter, while earned $15.35 billion. The entertainment company had a net margin of 19.61% and a return on equity of 20.44%. The firm's revenue was up 3.8% on a year-over-year basis. The Walt Disney Company has posted a 78% increase in profit for the quarter, thanks in part for the federal tax cut. The strategic investments the company made have driven meaningful growth over the long term, and it remains confident in its ability to continue to deliver significant shareholder value. Disney seems excited about what lies ahead with a robust film slate, the launch of the ESPN direct-to-consumer business, new investments in its theme parks, and of the acquisition of 21st Century Fox. Next up is the Sanofi. Sanofi has released its quarterly earnings guidance on February the 7th in 2018. The fourth quarter of Sanofi's 2017 sales reflect strong declines in the United States. Net sales were 8.7 billion euros, down 2% on a year-over-year basis. The company's EPS decreases by 8.8% to 1.06 euros, while its net debt was 5.2 billion at the end of 2017, a decrease from 8.2 billion at the end of 2016. Sanofi's board has proposed a dividend of 3.03, an increase of 2.4% in 2017. Business net income was unaffected by the American tax reform. For the future, Sanofi has acquired Bioverativ for $11.6 billion to expand it in specialty care and strengthen its leadership in rare diseases, while also acquired Ablix for $3.9 billion to strengthen its strategy with innovative nanobody technology platform. An agreement signed with Regeneron will accelerate the expand Sanofi's investments, including the anticipated contribution from the recent announced acquisitions, barring unforeseen major adverse events. Next up is the Christian Dior, who released its earnings guidance on February the 7th in 2018. The Christian Dior Group recorded revenue of 43.7 billion euros in 2017, an increase of 11% over the previous year. All business groups recorded double-digit organic growth with the exception of wines and spirits, whose growth in the second half was limited by supply constraints. Dior's key highlights from 2017 include record revenue and profit from recurring operations growth in Europe, the United States and Asia, and good performance for wines and spirits in all regions. Its success of both iconic and new products at Louis Vuitton, whose profitability remains at an exceptional level, the integration within the fashion and leather goods business group of Christian Dior Couture, which achieved excellent performance. Growth at Fendi and Loro Piana, the first year of integration of Rimowa, strong momentum at Parfums Christian Dior were driven by successful product innovations. An excellent year for Bulgari and good progress at Hublot and Tagoyer, growth at Sephora, which all strengthened positions in all the markets. Dior's free cash flow of €4.5 billion is up 15%. Next up is the Nvidia, who released its quarterly earnings guidance on February the 8th in 2018. Nvidia reported $1.72 earnings per share for the quarter and had revenue of $2.91 billion. The company's net margin was of 31.36% and had a return on equity of 47.44%. The business revenue was up 34% compared to the same quarter last year. Shares of Nvidia closed up 7%, holding up well amidst a brief market swoon, following better than expected fiscal quarterly results and a 2018 outlook. The report variously described as monstrous, tectonic, massive, and firing on all cylinders prompted another round of price target increases into the $300 neighborhood. It was a quarter once again dominated by talk of cryptocurrencies, which continue to help results. Nvidia is currently building the industry standard in artificial intelligence and is emerging as a leader in autonomous driving as well. Its systems are used by over 300 companies. In the near future, it will continue to expect its EPS grow to 30-35% throughout the next few years. Don't forget, our services are going to be soon only available for our subscribers. This was Attila Kovács from GTC News with the Stock Scope results for the 6 weeks in 2018.